Okay.
Yeah. Good morning, everybody. Welcome to our latest set of annual results. Well, 2020 was a year I think we'll all remember for a long time. Exceptionally challenging for all businesses, and let's not forget for me personally too. Last year we managed to adapt our working methods to allow us to remain open for business, which allowed us to deliver on key infrastructure projects, maintain employment and maintain payments to our suppliers. I'm very proud that despite such challenging circumstances, we put in a really good performance. EBITDA up to 23.9 million on turnover of 124.2, and very importantly, we grew EPS by 7% to 4.5p. We also stayed on track with our plans. We completed the remaining 60% acquisition of GD Harries. We completed the significant debt refinancing with a syndicate of 5 UK and European banks. We improved operational gearing and we initiated a formal sustainability programme. In December, we raised £12 million in a placing that was significantly oversubscribed. And I feel that demand demonstrates the confidence and support from our existing and new shareholders. We made a step change in governance to reflect the growth of the business with the appointment of 2 new NEDs, independent NEDs, Jack Empson and Simon Chisholm. We appointed a full-time CFO, Dean Mansfield, and we appointed Anthony Brockbank, usually experienced, as our General Counsel. We continue to make progress in 2021 with the foundations of a substantial aggregates business in Belgium, and the acquisition of 2 ready-mix businesses which are strategically located on the Albert Canal. There are more details on this later in the presentation. I'm now going to hand you over to Max to give you more detail.
Good morning. Thank you all for joining. We're moving on to slide 7 now. I'll give you a few more detailed insights in a few statements that David just made, and I'll hand over to Dean now for the financials to then come back to a few insights on what we've just bought in Belgium and here in the UK. So 2020 was indeed an interesting year. It was very much a year of 4 very distinct quarters in terms of trading, in terms of operations, in terms of challenges. Every month, pretty much, we have a significant step forward of some description. There's a summary on slide 7. There's a longer version of that in the full annual statement. A few highlights that David already mentioned. Obviously, we completed the acquisition of Stone Holdings. There's 2 quarries near the Liège area in Belgium, which had a good starting point for our aggregates business in the Benelux. The COVID crisis then obviously started in February and March. A lot of preparation went into making sure that the business was prepared to tackle whatever would come about of this crisis. Having a business in 2 different locations here in the UK and in Belgium meant that we could see the different responses from the different governments to the situation as it unfolded, and prepare a bit quicker, where the response was a few weeks later in time for us in the UK. So that helped us a lot. April was a very tough month. We'll come back to that a bit, but then we managed to bounce back out of that quite strongly, having positioned the business well. And as a consequence of that, the rest of the year, with a bit of help of the markets, with a bit of help of our structure, we managed to perform very well. We move to slide 8 in the presentation. A few sort of highlights on trading for the various platforms we've got. So last year we ran 4 platforms in total. I'll just go through the order of them as they were created. So the Rhône platform, the 2 businesses, Analyst, Jersey and Guernsey, and then the shipping business, had all in all a fairly strong year in spite of the lockdowns. The islands of Jersey and Guernsey had a different policy than some other regions. They had more strict, more full lockdowns across the months of April, and then subsequently later on again, with a strategy to eradicate the virus, which has been successful at. As a consequence of that, the drops in volume were quite significant, but also the rebounds, especially in Jersey, was also quite significant, which helped us deliver quite a good performance across the two islands. With Jersey clearly outperforming Guernsey this year, more so than other years, based on a strong second half. The precast platform PPG, consisting of the three businesses currently, Island Concrete, Poundfield, and CCP. Again, similar story here. Good start of the year with a number of large projects that were coming on stream in PPG. In Poundfield, decent demand for blocks, good demands for fence posts. The lockdown hit. The structure of that business with a lot of open air manufacturing and big production halls allowed us to stay open, allowed us to keep producing. As a consequence of that, even though there was a significant drop in volumes and demand, there was also a significant drop in supply at that point in time. We were still open, we continued to supply our customers, and that helped us with the rebound in May, being a bit quicker out of the starting blocks and on from there. Subsequent demand trends with home improvements, with some infrastructure projects, allowed us to sell through Poundfield quite a good amount of precast concrete to the various infrastructure projects and through CCP blocks in terms of home improvement and house building. Judy Harry's in West Wales, the third platform. Again, similar trends as perhaps more like the Channel Islands, fairly strong lockdowns, fairly strong drop-off in demand, more than 50% in the month of April. Bounce back subsequently, the launch of new and existing infrastructure projects, which were in varying scales in West Wales. We picked up quite a bit of work on that, and that helped us through the third quarter. Slight slowdown again in the fourth quarter because of weather and just general tendencies and trends in West Wales. And then last platform, Belgium, at that point still one. I will talk about how we changed that later. So Bluestone and to supply of materials into the wholesale installations. The Bluestone, the Dimension Stone business had a really good year altogether. We were very happy that we could keep the business running right across the lockdowns and the pandemic with the support of local managers, with the support of unions, and the support of staff, which is extremely helpful. It allowed us to continue to produce Belgian blue limestone, which then was applied in all sorts of projects, be it home improvements, swimming pools, to infrastructure, town squares. As a consequence, that business had a good year all round, trading in line or slightly ahead of time of 2019. So the bounce back out of the lockdown was again very strong. It wasn't particularly geared towards what Q3 and 4 would do in Belgium. When we made the outlook in September last year, the trading was fairly smooth through the latter parts of the year. That helped us to these great results. If you go to slide 9, we've actually given you a little bit of a perspective on this with a graph of turnover like for like for all the businesses that we owned in 20 and in 19, the same businesses. So the dark bar is the 2020 equivalent, and we see the strong drop-off in April, and then a bounce back in May, June, and then subsequently fairly strong trading compared to the 2019 numbers. We shouldn't forget that these numbers in terms of trading also include improvements that we made to these businesses to sell better, to sell more. So there's an effect of the market being supported, and there's an effect of our work. And as a consequence of that, and I'll come into the details of these various platforms on slide 10 later after this financial statement by Dean. We slightly restructured our group, but we're active across quite a nice few areas in the UK, the Channel Islands, and the Benelux. As you can see on the map, and I'll give you a few more comments on that later on. Another focus of the year, this particular year, was the entire governance structure that we've got. Every element of E, S, and G. There's a very substantial and dedicated section in the annual report which looks at our improvements along those lines with full sector reporting, emissions reporting, and so on. So a number of areas which are important to mention. So we've under the leadership of Charles Trigg, who's taken over this area as part of his remit, looked at the various frameworks that we could adopt in terms of sustainability frameworks, in terms of reporting for that. CFDs, and the Russell FTSE frameworks, and chosen to report against those in the annual report as we go forward. We've completely reviewed our governance structure, all the policies as well, which will feature on our website, and appointed Anthony Broadbank as our general counsel, again to reinforce the governance structure of the business. There's a few additional, two additional non-exec and independent directors who've joined us, as well as Dean as CFO, again to make the board more balanced in terms of the directors, executives, non-executives, and independents in there. And there's a whole risk framework which is now part of our reporting, which will be developed over time. And each year the section on risk will obviously expand further as the business grows in various markets. There's several initiatives that we highlight in the annual report as well. I'll probably point you to the full text of that and a few ideas. We now put commission phase 3 of our solar panels in Belgium, which will produce a third of the energy of that business, which is 425 staff, 50 million turnover business. It's a fairly substantial entity. Will that come from solar energy? We've done a lot of work to make sure that the diversity and leadership roles for women in the business is looked at, and a few promotions there. So we're very happy with that. And there's obviously this creation of several committees from a governance perspective. Also joined, for instance, the safety committee by non-executive director to make it an objective, and though it's an internal committee, that one objective entity to look at various challenges we've got in safety. So all that, I think, puts the business again a step forward in from an ESG perspective as we continue on this journey. I'll hand over to Dean now to go through the financials of 2020. Dean?
You have to unmute him, I think, for you're controlling his camera.
There you go. Morning, everybody.
Yeah.
So, if we're on slide 14, excuse me. So, good morning and thank you. And hopefully you've all had a bit of time to digest the RNS this morning. But the following few slides will give you sort of a flavour of the numbers. As Max and David have said, we've had a strong year. Excellent operational improvement, business integration, despite the challenges of the COVID pandemic. As you can see on the first graph, the first chart, the 77% increase in revenue. Obviously, that's with the inclusion now a full year of Carrier Dueno, part of GD Harries for the last 3 months of the year. And it's worth noting that whilst the growth on the slide is partly due to those inclusions, on a like-for-like basis, we have also had good organic growth within the businesses, as well as this sort of small acquisition uplift from GD Harries for the latter part of the year. Underlying EBITDA, a 64% increase to just under 24 million. Nice strong increase. In terms of EBITDA margin, slightly lower for the year at just over 19% against 2019 at just over 20%. But given, this was expected, given the April situation whereby we had a circa 50% drop in revenues, particularly in the Channel Islands, as Max mentioned, which had a pretty severe lockdown, particularly in Guernsey, which went on a bit longer than Jersey. Yet, despite that drop in revenues, we managed to remain EBITDA positive across the group. Underlying profit before tax increased to 12.2 million. And that obviously then knocks onto the final graph, whereby we've had a nice 7%, healthy 7% increase in our EPS, bringing us to 4.5 pence. If we go to the next slide, please. There's a snapshot from our income statement. Again, it demonstrates some of the numbers I've just talked about, the 77% increase in revenue. There's been a solid growth in profit after tax and EPS. Finance costs, there's an increase as expected with the full year inclusion of Carrier Dueno, which had some debt with it. That debt was refinanced alongside the existing Sigma Op debt with the new syndicated debt facility that we completed in December of last year, which brought all of the group's debt under the one facility. Tax continues to be relatively low. There's some offset and group relief that we're able to use. And just to give a bit more colour on the other net gain loss on the income statement, that's primarily a share of earnings from GD Harries when it was equity accounted as an associate. Just to give some explanation there. On the next slide, you can see the evolution of the balance sheet over last year. So we began the year with 9.9 million in cash and finished the year with just under 27.5 million pounds. That slide gives an idea of the sort of the bigger movements. There was the 1.8 million pounds, which is circa 2 million euros, acquisition of some farmland in Carriadhaino as part of the project for the extension. We funded the GD Harries acquisition from cash, the 7.5 million. There was some deferred payments, some deferred consideration on mainly on Carriadhaino on there. And then we had the equity raise in December 20 to bring us a healthy cash close at 27.5 million at the year end. As it says on that slide, it also mentions again about the debt refinancing that was completed. It's 125 million pounds facility. It includes a 40 million pounds accordion, and it's a syndicate of 6 banks, some strong UK and European banks, so reasonably balanced between UK and Europe, which we're pleased about. Next slide, slide 17. Just some key balance sheet statistics. The tangible assets, 84% increase, partly because of the acquisition of GD Harries. Obviously, that brings their assets onto the balance sheet under the full consolidation accounting. But also in 2020, we completed the purchase price allocation exercise on Carriadhaino, which reallocated circa 40 million to tangible assets from goodwill, which demonstrates the strength of the asset backing in Carriadhaino. Total assets, strong increase, again with the inclusion now of GD Harries, the increase of cash, so that's increased 24% our total assets on our balance sheet. A decrease in our net asset, partly because of the stronger cash, and which you can again refer to the cash at the final sort of block there. You'll see 177% increase to the 27.4 million cash at the year end, enabling us to start. It enabled us to start 2021 in a very strong position. I think that's my final slide. So I'm happy to take any questions at the end. In the meantime, I'll hand you back to Max. Thank you.
Thank you very much, Dean. That's great. So there's a few slides at the end of the presentation, which are primarily in relation to a few points that are quite important in relation to the evolution across the beginning of this calendar year. I'll refer you directly to slide 20, slide 19, is a bit of an overview of our strategy and purpose. But slide 20 is quite a nice reminder of the 4 key principles that we've now implemented since the beginning of this year. We have invest, improve, and integrate. We invest in high-quality businesses rather than acquire them, try to maintain the uniqueness of that business as much as possible, and then help develop it further and grow it. We improve it through our approach of management, our approach of running and owning these companies. We integrate them into platforms. We've had that approach for a number of years. We've added to that a 4th pillar this year, which is innovate. We're starting to look quite a lot into a number of areas. We've always had the brownfield business, which is a very innovative business from a precast perspective. There's all sorts of projects it has delivered in recent years. We also looked at how can we make this whole business more sustainable. And we did that with the launch of Greenbolt, which I'll come to a bit later on. As a consequence of the 4 pillars that we've had so far on slide 21, we're quite proud of a track record of year-on-year growing this company from a very modest start to where we are today, and we obviously look forward to continuing that journey. And as part of that journey, on slide 22, we've done a bit of work this year already in looking at what we could do in our Benelux operations. At the start of the year, we had one platform, CDH, which included a dimension stone arm and the supply of aggregates, crushed stone to the crushing installations of the Levars Vossen Group at Swansea. And we changed that, and we've now created 2 platforms. The first platform consists of 2 businesses located in the site of the Swanee site. We split that business up into two. We've split out on the one hand the dimension stone business, and on the other hand the construction aggregate business. Dimension stone is a very unique business. It sells Europe-wide, worldwide even. It's a dimension stone business, so the extractive techniques are different. The end markets are different, the customer base is slightly different. And so we felt that given the size of that operation, given the type of product it delivers, it should be a standalone platform on its own, which we've now done. Next to that, we've continued to create our Benelux platform, which now consists of 4 companies, 2 aggregate businesses on the one hand and 2 concrete businesses on the other hand. You see them located on the map of Belgium on slide 22. The first of those aggregate businesses is, if you go to slide 23, is located at our Swanee site, which is the CDH site. What we've done is we've taken over the crushing installations, plant machinery, and people of the LafargeHolcim group on the Swanee site. Up to date, up to now, LafargeHolcim had its own installation on site, and we were delivering into their primary crusher for them to then crush and finalize material to sell. What we've done is we've done a deal with them to take over their plant machinery and include the entire process from extraction all the way to finished good on our site under our control. That will increase our efficiency on site and increase the safety records on site, and it will prepare us nicely for starting the market as a full-scale producer and seller of the volumes that come out of the Swanee quarry. That's the starting point of the aggregates business. We've called this Granulat Hainaut, given the location in Hainaut and given its granulate or aggregate material down there. We included into this platform the 2 other quarries that we already had called at Stonewall, called Cuvilliers. There's 2 quarries there near the town of Liège along the Meuse River, supplying mostly the markets in the Liège area and then the waterway system up into Holland. As a consequence of that, total output is closing in for above 2 million tons a year from an aggregates perspective in the Belgian market, which is already fairly sizable. And to include as well a little bit of downstream activity, we've now completed 2 acquisitions in Belgium for 2 very nice and well-located concrete businesses in the province of Limburg. If you look at the Belgian map, you've got Liège on the right, Limburg is right in between there, and then Antwerp on the left of it. So it's a very nice area to operate in. It's a wealthy area, it's a wealthy part of Belgium. As I said, it's got 2 big industrial hubs on the one hand, Antwerp on the other hand, Liège, the fourth map of the industrial areas of Liège. It's along, both are located along the Albert Canal. The canal protects 2 big rivers, the Scheldt and the Meuse. The combined output of these 2 businesses is about 250,000 meters cubed a year for approximately 3.3 million EBITDA for last 2020. The location is strategic. The assets are in very good condition. The asset base is good. The number of machinery is good. And so, as a starting point of concrete business in that area, these 2 businesses are ideally placed. So we look to then integrate this into the rest of the platform in terms of aggregates and supply of aggregate to these 2 companies, and then grow that platform again. We then move to slide 25. We also launched one of those innovative products at the beginning of this year called Green Block. It's a sustainable alternative to a dense concrete building block. The dense concrete building blocks are very commonly used in the construction of housing and infrastructure across the UK. We developed a block that has a 70% embodied carbon CO2 reduction, about 2,700 kilograms of carbon of CO2, embodied CO2 saved per average house built, which is a very substantial reduction. It's the starting point for us in this space of sustainable building products. We clearly have a strategy to expand the Green Block line and to go from a standard building block to other products that we have in the group. And as we progress along that journey, we will come up with new updates how this evolves across the year. If we then finally close out on the last slide, which is a bit of an outlook on slide 26. The first quarter of this year has been a good quarter, despite a few bumps like in the road from freezing cold weather, snow in Belgium, snow in Ipswich, and a 3-week lockdown in the island of Guernsey. Despite all that, trading has been good, volume has been good, and we're nicely on track of our budget for the first quarter. The half, looking ahead in terms of what this third half is going to do, it's an interesting position to be in. There's quite a lot of demand still from housing and house improvement and home improvement. Demand from infrastructure starts to kick in now. We need to have a look at what the end of lockdowns in the various economies is going to do. If there's shifts in demand patterns from that, there's less home improvement and more infrastructure coming through at that point in time. So that's something that we're very much looking at the moment. And so far, trading has been very strong, so very happy. Investment and growth, we're looking very much at expanding our footprint organically. There's a number of projects ongoing, which we announced at the end of last year as well, to look at what have we got in terms of asset base, what can we do more with the assets that we've got already. And we'll come out with a few updates later in the year as well. And then from an innovation perspective, well, the Green Block product line has been launched, and a lot of work is done in the background to expand our product base and our technology from that perspective, to again be at the forefront of what's being done in sustainable building products. So this completes the slides of these annual release of results. Very happy to take any questions if there are any. Clyde, I see you've got a question.
Max, yes, it's Clyde. I've got a few, if I may. One, can you just sort of update us a little bit on pricing, just around the group in terms of, sort of, I suppose, products and sort of different geographies as to what you're sort of expecting to see this year. Secondly, on costs, what sort of, again, expectation have you got in terms of sort of cost inflation? And the other one I had really was on Green Block. I mean, it sounds a very interesting product, and I'm sure the house builders will look very kindly on that. Is there a raw material issue in terms of that will limit the amount of block that you can produce with that, change in formula that would constrain you in terms of selling the block? Because I can see some good demand for that coming forward.
Okay, so in terms of pricing, so the first question you got, pricing is obviously, given the different types of business we're in and the different geographies, the pricing is going to be very different in each geography. Across the group, pricing has moved forward. In some cases, in line with inflation, in some cases, a bit more than that. Depends entirely on where we are from a product perspective and a geography perspective. But everything from that perspective is as expected. Demand has been strong in some areas, for instance, precast products and so on. But those deals are primarily governed by year-long or deals from buying groups. And so negotiations on pricing and volumes were held at the end of last year. For the rest, across the group, the pricing is helping. We haven't seen any move backwards anywhere. That's the question in that perspective. In terms of input costs and raw materials and so on, well, we had 2020, obviously, price of oil and fuel collapsed at the beginning with starting COVID prices, which is obviously something that helped everybody in the industry. Price of fuels and oils is still lower of very reasonable compared to some past years. So there's a bit of benefit from that. If that starts to move forward, then that will increase costs a little bit. It seems that cement, one of the key inputs in the market, is because of all the demand that's going on, is in fairly high demand. We've got a good setup in terms of supply of cement in the group, so we should be able to control that cost as well. Labour and everything else is fine. So far, from a cost perspective, we're managing it well, I think. Then the Green Block aspect, in terms of raw materials, in terms of demand for that, it's received a really warm, been very well received by pretty much all our customer groups. It's very much a specifier product. It's very much a product that goes into big developments and are specified into that, so that's being carried out at the moment. And so as we see those projects coming on stream, we see the demand for green block going up. In terms of raw materials, it's very classical raw materials that go through. It's the same supply chains as we had already. So what we've got in terms of supply for other applications is also the supply for this green block. And so from that perspective, I don't think that our use of or our production of green block is going to create a shortage of material. It's just simply the building industry in general that will, if that continues to be very buoyant, that may create such impacts.
Thank you.
Any other questions from anyone on the phone? No, Charlie?
Hi, morning, everyone. Yeah, sort of a few from me, if I can. I just want to sort of looking forward to 21. I just wonder if you might sort of pick out the sort of the top 3 or 4 maybe actions that you've got kind of underway to improve margins, just so we can understand what sort of things, what levers you're pulling to improve profits in 21. Second question on Bluestone. Clearly, you've done some great work in terms of the aggregates and improving the profitability from that stream. But just wonder what you've done within the Bluestone to improve either revenues or profit. I guess we were talking about maybe some more exports at the time. Just wondering sort of how progress is on that. And last question, I think Dean, you were saying in your presentation that you'd seen some reasonable organic growth in the year just gone. I just wonder if you might quantify that for us, or at least give us a bit more colour on which bits of the group have seen some organic growth in 2020, just to help us think about how the underlying progressed in the year. Thank you.
Okay, so I'll try to go through the first couple of questions you had there, Charlie, which is to do with margin improvements and across the year and what we've done on Bluestone, practically they're tying together quite nicely. So the big focal point from our perspective here this year, the margin improvement is to look at the businesses that are lower margin businesses across the group. So that's obviously the ones that are more commodity producers and the newer ones. So that's South Wales primarily, and if you're the old ones that we've got, for instance, Planfield business, not a low margin business, had low margin components, and then the CCB business, which is a commodity producer. So if you go through those 3 to start with, GDH comes in as a lower margin group. It's got to do with a whole bunch of reasons for how that business is structured, how it's run, how it's built up, and so on. So that's going to be a plan or an effort right across this whole calendar year to improve that margin. We're looking at every single component of that business currently. So it's got a strong contracting arm, looking at how efficient that contracting arm is. We're looking at the material supply. Lots of quarries in various regions, lots of assets across these quarries, concrete plants, asphalt plants. What quarry supplies what ready-mix plant, what quarry supplies what asphalt plant. Make sure that we don't double handle material. Just a general best practice. Let's look at how we make this business more efficient. As a family business that grew fairly aggressively, fairly quickly across the years, it sort of also outgrew its sort of central management approach a little bit. So we're improving the quality of that quite dramatically. All of those things should help it get a better visibility of the product it makes, better visibility on its logistics, better visibility on its deliveries to customers. And as that goes, as that takes hold, that program takes hold across this calendar year, we'll be able to improve margins there. That's point number 1. Look at CCP and Planfield, CCP block maker. We're constantly looking at how can we utilize that plant more efficiently, how can we reduce cycle times in terms of the creation of the blocks. We're commissioning a new architecture around the ovens on one of the sites. We're commissioning an empty shed at Clyde to see if we can make some extra product out of that second shed there. See if we can increase the distribution of margins across these two production hubs there and increase the overall margin of the business. So that's being looked at very much as well. Hounsfield has the component which is being block flooring. It's a nice business to have because it gives a base volume to that company. It means that we can always keep the teams busy, but it's also the lowest margin of the three divisions that they've got there. So reduce the importance of that and increase the importance of the infrastructure delivery and the retaining wall delivery is going to help us with margins there as well. Then if we can roll out a few more green products, they typically attract a bit of a higher margin as well, which will help overall from that perspective. We go to Bluestone in Belgium. The Bluestone business was, it was a little bit, how do I say this? It was a business that had focused for the last 7-8 years its entire effort and energy on the attention on obtaining the extension to its permits and licenses and to its extractive area. That was the focus of what that business was doing. Operational efficiency, being quicker at producing stone, being more efficient at producing stone, being more efficient primarily at producing materials to the Lafarge wholesale installation wasn't the focus. The focus was, are we going to have reserves 5 years from now? And then just before we bought the business, that problem was solved effectively by the change of use on the extra land that they bought. They bought 100 pieces of farmland across the area there to make sure that they had enough land to either extract from there or swap against other pieces of land that they needed. So that was the focus for 7 years. We've now switched the attention at the business with a few management changes, a few streamlining changes to make sure that that business is now much more focused on how do we operate efficiently, quickly, safely. Another one, how do we align better the extraction of standard aggregate on the top and bluestone at the bottom. For instance, how do we do bigger blasts without damaging the bluestone below? How do we extract more blocks of a bit bigger size and better quality? How do we streamline the process to the factory? All of that means that the margins of that product have been steadily, not dramatically, steadily increasing, and efficiency is increasing as well. So it's not necessarily the sales in extra markets that push this primarily last year. It's primarily internal efforts. There is a focus on a push on extra sales and extra markets. So we've now attacked the Scandinavian market with the partnership up there. We've got a full-time rep here in the UK. We're trying to see if we can put some standard products through the PPG business as well. We started to put some sales into the Channel Islands, and we're developing the markets that the Bluestone business was already in: France, Germany, Italy, Switzerland, with the sales team locally. So all of that is very much on track. And then there's a whole bunch of marketing efforts in the background, which we'll be able to tell you more about in the future, which will also help that business. So that's roughly where the efforts are in terms of Bluestone. Dean, would you like to pick up the next question?
Yeah, sure. Thanks, Max. You did slightly steal my thunder in some of your comments there, which I think explained some of the reasons for the organic growth. So I'm just going to put my video on. There you go. So Charlie, yeah, just to add some more to what Max said, the things like with operational efficiencies, particularly in CDH, just changes in shift patterns, operational improvements, that leads to organic growth. When we start looking on like-for-like bases and comparing 20 against 19 in previous years, those operational efficiencies come, and even safety initiatives, they come through to the bottom line. You know, I'm not an operational expert, but looking at that level, it's looking at where you've got trucks running idle for 6 hours, changing shift patterns so that you don't have wastage like that. So those type of operational improvements leading through to the bottom line. In Poundfield, I think as Max touched upon, with some of the larger, slightly better margins on some of the larger bespoke projects, Allen Concrete, again, strong demand for its products, and ensuring that the operational efficiencies and costs are managed. With the increase in the demand, it leads to organic growth there. In the Channel Islands, Rhone, again, just a complete management of cost. Rhone is slightly different in that it's a bit more mature. So whilst there's always margins for improvement, with it being a mature business to the Sigma Rock group, a lot of the hard work is done, but we continue to improve. Then looking forward, obviously, that'll be the same sort of focus put on the GD Harry's business, looking at the margins, looking at operational efficiencies and safety initiatives and where we can improve. And it's strange because health and safety always feels like it's a cost, but actually when you improve health and safety, it tends to make the whole operation smoother, which leads to a better bottom line. It can sometimes be counterintuitive. A lot of people can view health and safety as just a cost out of the business, a necessity, but by making processes safer, smoother, it does lead to organic growth. So I guess that's the main highlights that I would pick on.
Thank you very much. Thank you.
Good. Any other questions from anyone?
Max, David, can I have another one as well, if I may, please? On the acquisition pipeline, how has that evolved in, I suppose thinking in the different geographies? And clearly you've been pretty active in Belgium of late, but as we look forward over the next 6, 12, 18 months, would you expect there to be a balance on deals either side of the channel, or again, is the focus likely to be around the Belgium/Benelux market over the more near term?
Oh, it's going to be the focus has always been the first focus is where can we find a good business at a good price. That's the first focus. And if that business has a certain size, it allows us to mobilize in a new area, then we will consider doing that. But that's what we did in 19 with Belgium. It was a logical conclusion of having a business that does dimension stone and aggregates to then see if we can do something more on aggregates and construction materials in the Belgian area as well. So that was essentially a follow-on from what happened in the end of 19. So it's slightly logical to view that as a certain continuation on the same project. If you look at the UK, we've got GDH, we've got PPG. There are two entities that could very much expand, probably organically, because they've got a great asset base, a great footprint, great skill set in the business itself. Can they do more at different locations? That's obviously something that we're actively looking at, and the likelihood of that being the first next step would be fairly high. Then, in terms of the rest of the UK, what else can we do? It's entirely dependent on where do we find a good business at a good price. If you don't buy it well, you're stuck with the problem of having to pay too much at the beginning. So we always want to avoid that. So there's not necessarily a preference in what geography it is, if that answers your question.
Yeah, perfect. Thank you very much.
Is that all the questions?
Great. I think that's all the questions we've seen so far through the feed. I thank you all for participating this morning in this call. And I think we'll close it off here.
Yep. Thank you very much. Thank you. Thank you, everyone.
Thank you.
Thank you.
Thank you.